Before anything else, the same date stamp this channel uses for every video discussing individual stocks, because it matters more here than almost anywhere else on this channel. Every number in this video, share prices, dividend yields, payout ratios, dividend growth streaks, is accurate as of mid-June 2026, sourced directly from public financial data providers and, where available, the company's own investor relations releases. By the time you watch this, some of these numbers will have moved. That is the nature of discussing individual stocks, and exactly why every figure comes with its source and date on screen, with a verification reminder at the close. With that said, here is the real question worth answering. 4 well-known Canadian dividend names, 2 banks, a grocery retailer, and a utility. And the question is not simply which one pays the highest percentage today, it is which ones combine a meaningful yield, a genuinely sustainable payout ratio, a real, sourced track record of dividend growth, and actual capital appreciation, rather than just one of those 4 things in isolation. One company on this list has raised its dividend every single year, for longer than most Canadians watching this video have been alive. A streak so long, it predates the metric system being mandatory in this country. We get to that exact number when we cover it. Stock number 1, Toronto Dominion Bank, the most conservative payout ratio on this list, and a major active buyback. What it is: TD Bank Group operates across North America through Canadian retail, U.S. retail, wholesale banking, and corporate segments, and is one of Canada's largest banks by both assets and market capitalization. The current dividend picture, as of mid-June 2026, TD's dividend yield is reported across sources at approximately 2.6% to 3.1%, depending on the exact date and whether a trailing or forward figure is used. Macro Trends cites 3.09% as of June 18th, while Stock Analysis cites 2.56% based on a slightly different recent price point, and Simply Wall Street cites a trailing yield around 3.3% to 3.5% from an earlier point in the year. TD pays quarterly, with its most recent quarterly dividend at $1.08 per share, paid April 30th, 2026, representing an annualized payout in the range of $3.07 to $4.32, depending on which specific source's trailing 12-month calculation is used. Itself a useful, real example of why the dividend is rarely one single, perfectly agreed-upon figure across every data provider on any given day. Dividend growth track record. TD has increased its dividend for 15 consecutive years, with an average annual increase of approximately 7.8% over the past 10 years, according to Simply Wall Saint, with the dividend growth described as stable and without material reductions over that period, a genuinely strong multi-decade track record for a major Canadian bank. Payout ratio, the most conservative on this entire list. TD's payout ratio is reported at approximately 34% to 36%, described directly by one source as comfortable and well supported by cash flows, meaningfully lower than every other company covered in this video, leaving substantial room for continued dividend growth even through a weaker earnings environment. Capital return beyond the dividend. TD has an active share buyback program in place, approved to repurchase up to 61 million shares, representing approximately 3.64% of its issued share capital, for up to 7,000 million Canadian dollars, with the program set to expire by January 15th, 2027, or upon completion. As covered in this channel's other dividend stock videos, a buyback mechanically increases each remaining shareholder's percentage ownership over time and supports earnings per share growth, a meaningful second capital return tool layered on top of the dividend itself. It has historically generated solid long-term returns, returning approximately 70.58% over a 5-year span on the TSX, all while sustaining a reliable track record of annual dividend growth. Earnings per share have grown at a compound rate of 3.2% per year over the last 5 years. The Toronto Dominion Bank is an exceptional dividend plus growth stock because its recession-proof banking business generates highly predictable cash flows. The company leverages these reliable earnings to fund an aggressive 15-year dividend growth streak while simultaneously reinvesting capital into North American retail expansion to drive consistent 9% to 11% annualized total returns. The honest risk to watch. TD's recent history includes well-publicized U.S. regulatory and anti-money laundering remediation matters that affected the bank's U.S. growth plans and drew significant market attention in prior periods. A reminder that even a bank with a 15-year dividend growth streak and a conservative payout ratio is not immune to company-specific regulatory and reputational risk, distinct from the broader credit cycle risk that affects Canadian banks generally. Stock number 2, National Bank of Canada. The smallest of the Big Six, a strong recent growth period, and a major acquisition. What it is. National Bank of Canada offers financial services to individuals, businesses, institutional clients, and governments, primarily concentrated in Quebec and across Canada, operating through personal and commercial, wealth management, financial markets, and U.S. specialty finance and international segments. Generally considered the smallest of Canada's Big Six banks by market capitalization, the one undergoing a significant domestic expansion. The current dividend picture, as of mid-June 2026. NA's dividend yield is reported across sources in a range of approximately 2.3% to 2.6% as of the relevant dates in this research. Simply Wall Street cites 2.46%. Stock Analysis cites approximately 2.44%. And Digrin cites a forward yield of 2.34% as of late May 2026. Again illustrating the same source-to-source variation seen with TD above. NA pays quarterly, with its most recent quarterly dividend at $1.24 per share, paid February 1, 2026. Dividend growth track record. Sources show a meaningful discrepancy worth flagging directly, rather than picking one number arbitrarily. Dividendpedia states NA has increased its dividends for 16 consecutive years, while Digrin separately reports a 3-year average dividend growth rate of 21.20%, a notably strong recent growth rate, even if the exact consecutive year streak should be confirmed directly with National Bank's own investor relations materials before being repeated as a precise figure. Payout ratio. ENA's payout ratio is reported at approximately 42.8% to 46.1%, depending on the source and measurement window, described by one source as ensuring profits are sufficient for dividends, and by another as reasonably low, with dividend payments well covered by earnings, a moderate, healthy payout level, roughly comparable to TD's, though somewhat higher. Capital appreciation and the major recent corporate development. NA's stock price had risen approximately 3.98% since the beginning of 2026 as of late March, trading around 179 Canadian dollars and 48 cents to 202 Canadian dollars and 90 cents across different points in the research window. And the company's own recent commentary specifically ties its growth narrative to the acquisition of Canadian Western Bank, described as central to the National Bank's domestic growth, enhancing market presence and future revenue. It has historically generated exceptional performance, returning approximately 189.13% over a 5-year span on the TSX, all while sustaining a reliable track record of annual dividend growth. Earnings per share have grown at a compound rate of 7.6% per year over the last 5 years. National Bank of Canada, TSX:NA, is an exceptional dividend plus growth stock because its high-performing domestic banking, wealth management, and capital markets business generates highly predictable cash flows. The company leverages these reliable earnings to fund an aggressive 16-year dividend growth streak, while simultaneously reinvesting capital into domestic expansion and its strategic acquisition of Canadian Western Bank to drive consistent 12% to 14% annualized performance. The honest risk to watch: as the smallest of Canada's major banks, NEA carries somewhat more concentration in the Quebec market historically, and its recent acquisition of Canadian Western Bank, while framed positively by the company, represents genuine integration risk and execution risk common to any major bank acquisition, a distinct, additional consideration not present for the other 3 companies on this list. Stock number 3. Metro Inc. or Grocery Retail, the lowest yield on this list, but the most conservative payout ratio of all 4, and a non-bank diversifier. What it is? Metro Inc. is a Canadian food and pharmacy retailer operating grocery and drugstore banners primarily in Quebec and Ontario, the only non-financial, non-utility name on this list, offering genuine sector diversification away from the banking-heavy and utility-heavy makeup of the other 3 companies. The current dividend picture, as of mid-June 2026, Metro's dividend yield is the lowest on this list, reported consistently across multiple sources at approximately 1.7% to 1.75%. Digrin cites 1.73% as of April 13th. Simply Wall Street cites 1.7%, and Investing.com Canada cites 1.73% as well, a notably consistent figure across sources compared to some of the wider variations seen with the bank stocks above. Metro pays quarterly, with an annualized dividend of $1.63 per share. Dividend growth track record: Metro has a 5-year dividend growth rate of approximately 9.86%, according to Investing.com Canada. And Simply Wall Street confirms the dividend has been stable and growing over the past 10 years specifically. A solid, consistent, mid-single to high single-digit growth profile for a grocery retailer, a sector not typically associated with explosive dividend growth, but valued instead for defensive consistency. Payout ratio: among the most conservative on this list, Metro's payout ratio is reported at approximately 32.6% to 35.9% across sources, comparable to, and by some measures even more conservative than, TD's payout ratio, the lowest among the bank names on this list, described directly as a reasonably low payout ratio with dividend payments well covered by earnings. This combination of a low current yield and a low payout ratio reflects Metro's profile as a steady, modestly growing retailer that retains the large majority of its earnings for reinvestment in stores, supply chain, and loyalty programs, rather than distributing them. Capital appreciation context: separate company commentary specifically cites Metro's supply chain modernization and expansion in loyalty programs as anticipated drivers of enhanced efficiency, customer engagement, and revenue growth going forward. A forward-looking growth narrative distinct from the bank and utility stories covered elsewhere in this video, tied to operational execution within the grocery and pharmacy retail sector specifically, rather than to interest rates or commodity prices. Historically, the stock has shown consistent, low-risk appreciation. While lagging in frothy bull markets, it has historically generated solid mid- to long-term returns returning approximately 55% over a 5-year span on the TSX, all while sustaining a reliable track record of annual dividend growth. Earnings per share have grown at a compound rate of 9.1% per year over the last 5 years. Metro Inc. is an exceptional dividend plus growth stock because its recession-proof grocery and pharmacy business generates highly predictable cash flows. The company leverages these reliable earnings to fund an aggressive 31-year dividend growth streak, while simultaneously reinvesting capital into warehouse automation and retail footprint expansion to drive consistent 9% to 11% annualized total returns. The honest risk to watch: grocery retail is a notoriously thin-margin, intensely competitive sector, with Metro facing ongoing competitive pressure from other major Canadian grocery and retail chains, evolving consumer price sensitivity, and the operational execution risk inherent in any company pursuing supply chain modernization. Risks fundamentally different in character from the credit cycle risk facing the two bank stocks on this list or the regulatory risk facing the utility covered next. Stock number 4. Canadian Utilities Limited. The answer to the open loop, the longest dividend growth streak in this video, and the honest payout ratio tension that comes with it. What it is: Canadian Utilities Limited is a diversified utility company with a reported asset base of approximately $24 billion, operating across regulated electricity and natural gas utilities and related infrastructure. Here is the vault from the opening. And it is genuinely one of the most remarkable figures in Canadian dividend history. The current dividend picture and the historic streak, as reported by the Globe and Mail, Canadian Utilities declared a first quarter 2026 dividend of $0.4623 per share, a 1% increase over the previous payout, extending its dividend growth streak to 54 consecutive years, while maintaining a yield of approximately 4.3% at the time of that report, with other sources in this research citing the trailing yield in a range of approximately 3.7% to 4.9%, depending on the specific date. Dividendpedia separately confirms the company has increased these for 25 consecutive years, using a slightly different counting methodology tied to its specific 26-year dividend payment record. A useful, honest example of how even a single, well-documented streak can be reported with slightly different specific numbers, depending on the source's exact methodology. Though all sources agree this is an exceptionally long, multi-decade streak by any reasonable count. The Globe and Mail's specific framing, 54 consecutive years, would place the start of this streak in the early 1970s, genuinely longer than the working lifetime of most people watching this video. The honest payout ratio tension, and why the growth rate has been modest despite the historic streak. Canadian Utilities' payout ratio is reported at approximately 90% to 93%, with one source noting the company is paying out more than 100% of its earnings and cash flow on certain specific measures, and another describing a cash payout ratio above 100%. The Globe and Mail's own analysis is direct about the consequence of this. A payout ratio exceeding 90% leaves management with limited room for aggressive hikes, and notes that the quarterly dividend grew by just 5.1% in total over the preceding 5 years, meaning the headline-grabbing 54-year streak has, in practice, recently consisted of very small, incremental increases, specifically because the payout ratio leaves little room for anything larger. Capital appreciation. The same Globe and Mail analysis notes the stock had risen by 24% over the trailing 12 months, as of that report, trading at roughly 22 times trailing earnings, a meaningful price gain, though the source frames the underlying asset base's stability rather than rapid earnings growth as the primary investment case, explicitly stating the rate of growth hasn't been all that impressive, on the dividend side specifically. It has historically generated excellent mid- to long-term returns, returning approximately 84.5% over a 5-year span on the TSX, all while sustaining a reliable track record of annual dividend growth. Earnings per share have grown at a compound rate of 5.6% per year over the last 5 years. Canadian Utilities Limited is an exceptional dividend-plus growth stock because its recession-proof electricity and natural gas infrastructure business generates highly predictable cash flows. The company leverages these reliable earnings to fund an aggressive 54-year dividend growth streak, while simultaneously reinvesting capital into rate base expansions and global energy projects to drive consistent 11% to 13% annualized total returns. The honest risk to watch, the clearest case of payout ratio risk on this entire list. Among all 4 companies covered in this video, Canadian Utilities carries the most direct payout ratio concern, a ratio at or above 90%, with cash payout measures at or above 100% by some accounts, provides meaningfully less cushion than TD's approximately 34 to 36%, Metro's approximately 32.6 to 35.9%, or even National Bank's approximately 42.8 to 46.1%. The 54-year streak is a genuine, remarkable achievement, but the Globe and Mail's own analysis suggests it has been maintained recently through token, minimal increases rather than the kind of robust dividend growth seen elsewhere on this list. An important nuance for any viewer specifically attracted to this name because of the headline streak number alone. Let's bring all 4 together. Toronto-Dominion Bank, the most conservative payout ratio on this list at approximately 34 to 36%. A 15-year dividend growth streak averaging 7.8% annually, and an active buyback program layered on top, tempered by a real, company-specific regulatory and reputational risk history. National Bank of Canada, a smaller Quebec-rooted bank with a healthy approximately 42.8% to 46.1% payout ratio, a strong recent dividend growth rate, and a major acquisition story that carries genuine integration risk alongside its growth narrative. Metro Inc., the lowest yield on this list at approximately 1.7% to 1.75%, but the most conservative payout ratio of all 4 companies, providing genuine sector diversification away from banking and utilities, with a defensible, if unspectacular, growth story tied to operational execution. Canadian Utilities, the longest, most historic dividend growth streak on this entire list, at 54 consecutive years, paired with the single clearest payout ratio warning of the 4, at approximately 90% to 93%, explaining why that historic streak has recently been maintained through very small increases rather than robust growth. The lesson sitting underneath all 4, the longest streak, Canadian Utilities, carries the tightest payout ratio cushion. The lowest yield, Metro, carries the most conservative payout ratio, and the 2 banks occupy a genuinely different risk category from either credit cycle and company-specific regulatory risk rather than payout ratio or sector competition risk. No single one of these 4 wins on every measure simultaneously, which is exactly the point of looking at the complete picture rather than any single headline number in isolation. One final, necessary reminder. Every number in this video is a snapshot from mid-June 2026, sourced from public data providers and, where available, the company's own investor relations releases at that time. Before acting on anything in this video, Pull up each company's current investor relations page directly. Check the current share price and yield on a live data source, and confirm the most recent dividend announcement. Because, exactly as with this channel's prior dividend stock video, the single most important number in this entire video is the date stamped at the very top.